In 2008, the American economy didn't just stumble, it collapsed, and almost nobody saw it coming, including the people who built the system that caused it. It started with houses, specifically with the idea that house prices in America never go down. Banks and mortgage lenders spent the early 2000s betting everything on that assumption, handing out home loans to people who couldn't afford them, packaging those loans into complex financial products called mortgage-backed securities, and selling them to investors around the world as if they were as safe as government bonds. They weren't. The ratings agencies, the firms paid to tell investors how risky these products were, gave them their highest ratings anyway. Some of the analysts knew the underlying loans were garbage. They rated them AAA regardless. The conflict of interest was structural. The banks paid the agencies to rate their own products. Meanwhile, Wall Street had invented a new instrument called a credit default swap, essentially an insurance policy on these mortgage products. AIG, the world's largest insurance company, sold hundreds of billions of dollars worth of these swaps without setting aside a single dollar in reserve to cover potential losses. They collected the premiums. They assumed the risk would never materialize. Then house prices fell. It began slowly in 2006, accelerated in 2007, and by 2008 it had become a full collapse. Homeowners who had borrowed more than their houses were worth began defaulting in enormous numbers. The mortgage-backed securities that Wall Street had sold around the world started failing. The insurance that AIG had written on those securities came due all at once. AIG couldn't pay. The entire financial system had been wired together so tightly that one institution failing threatened to pull everything else down with it. On September 15, 2008, Lehman Brothers, one of the oldest and largest investment banks in the world, filed for bankruptcy. It was the largest bankruptcy filing in American history. The stock market went into freefall. Credit markets froze. Banks stopped lending to each other because nobody trusted that the institution on the other end of the transaction would still exist the next morning. The US government had to make an impossible choice in real time. It had already rescued Bear Stearns and taken over Fannie Mae and Freddie Mac. It let Lehman fail and immediately regretted it, as the panic that followed nearly destroyed the global financial system within days. It then poured $85 billion into AIG to prevent its collapse, on the grounds that AIG's failure would trigger a chain reaction that no government anywhere could contain. Congress passed a $700 billion bailout, the Troubled Asset Relief Program, in October 2008. The political backlash was immediate and never fully subsided. The banks that had caused the crisis were rescued with public money. The homeowners who had been sold loans they couldn't afford largely were not. 8 million Americans lost their jobs. Millions lost their homes. Not a single senior Wall Street executive went to prison. What made 2008 different from previous financial crises wasn't greed. Greed is a constant. It was complexity. The system had become so interconnected, so layered with instruments that even their creators didn't fully understand that when the underlying assumption that house prices always go up turned out to be wrong, there was no circuit breaker, just contagion, moving at the speed of electronic trading across every major financial institution on Earth simultaneously. The reforms that followed, the Dodd-Frank Act, new capital requirements, stress tests for banks, were real but incomplete. The fundamental tension between financial innovation and systemic stability was managed, not resolved. The next crisis will look different. It always does. But the mechanism, complexity masking risk, until the risk becomes undeniable, tends to rhyme. If you like this piece, please consider liking and subscribing. See you next time.